You ever stop and think about how that rent check you cash or that payment you get on Venmo is somehow connected to the US national debt? I mean, they seem worlds apart, right? Well, they're not. They're actually all just gears in one giant, incredibly complex financial machine. So let's dive in. We're going to connect the dots from your own personal finances all the way up to the country's balance sheet. So what is the real link here? What connects, say, a two-bedroom rental property to literally trillions of dollars in government debt? The answer, it turns out, is this fundamental push and pull. On one side, you've got this system of powerful incentives trying to get you to do certain things, and on the other, a whole web of compliance rules designed to capture revenue. Let's break it down. All right, first up, the incentives. See, the tax code isn't just about grabbing money. It's actually a really powerful tool for steering the entire economy. It encourages people and businesses to do things the government wants done, like providing housing, by offering some very compelling tax breaks, especially when it comes to real estate. And right at the heart of all these incentives is this concept called depreciation. Think of it like this. The government lets you treat the physical building of your rental property like any other business expense that wears out over time. So, you get to deduct a slice of its value every single year, and that directly lowers your taxable income. But, it gets so much more powerful. You see, with standard depreciation, you're spreading that deduction out over decades. But there's this strategy that uses something called a cost segregation study, which is basically just a super detailed analysis of everything in the property, and it lets you accelerate those deductions. You can front-load a huge chunk of them into the first few years, which gives your cash flow a massive, immediate boost. And depreciation is really just the star of the show. There's a whole supporting cast of other deductions here. You've got mortgage interest, property taxes, all your repairs, insurance. I mean, the list just goes on, and every single one is another lever in the system designed to lower the tax bill for people providing housing. So this is the really crucial point. It's a paradox, right? The system gives you this huge tax deduction for an asset that, let's be honest, is probably gaining value. This is one of those foundational core mechanisms that makes real estate such an incredible vehicle for building wealth. Okay, now let's flip the coin and look at the other side of this equation, compliance. All those tax breaks, they have a cost. And to fund everything, the government needs to collect tax revenue. And that means it's getting way more sophisticated at tracking how money moves around. And this timeline just perfectly illustrates that trend. Before 2021, payment apps like PayPal or Venmo only had to report your business income to the IRS if you made over 20 grand. Now just look at how aggressively that threshold is dropping. The plan is to bring it all the way down to a mere $600. But here is a really key distinction. This is for business income only. So if you're an artist and you sell a painting through one of these apps, yep, that counts. But if your friends are just paying you back for dinner on Venmo, that's a personal reimbursement. It's not reported. And understanding that difference is absolutely vital. And get this, here's one of those non-obvious details. Zelle actually operates differently because it's not a third-party processor. It just sets up a direct bank-to-bank transfer. So it's currently exempt from all these 1099-K rules. It's a really fascinating little exception that's baked right into the system's architecture. Okay, so we've seen the federal push and pull, the incentives and the compliance. Let's zoom out just a little bit and see how these same principles can create these really unique economic environments at the state level. And we're going to use Florida as a perfect case study. What Florida does is it stacks incentives to attract residents and capital. First off, no state income tax. That applies to your job, your rental income, everything. Then you've got these powerful property tax benefits, like the homestead exemption, and even a hard cap on how much your property taxes can go up each year. Let's actually see that cap in action. So imagine you own your main home in Florida.
And one year, the property market just goes completely nuts. The market value of your house shoots up by 10%. So your tax bill is about to skyrocket, right?
Well, not exactly. Because of the state's Save Our Homes cap, the assessed value of your home, what you're actually taxed on, can only increase by a maximum of 3%. This creates this huge and growing gap between what your house is worth and what you pay taxes on. It saves long-term homeowners an absolute fortune. All right, now for the final zoom out. Why? Why does the government need to be so aggressive with compliance while at the same time giving away billions in tax incentives? Well, it's all happening against the backdrop of the single biggest number in finance, the national debt. This number is the backdrop for everything we've been talking about. The U.S. national debt, over $36 trillion. It's a number so vast, it's almost meaningless by itself. I mean, it's more than the economies of China, Japan, Germany, and the UK combined. To make any sense of it, you have to scale it down. So according to expert analysis, here's the personal equivalent. Just imagine you make $50,000 a year, but you spend $70,000, and you're already $360,000 in debt. That, scaled down, is the financial situation of the country. It really puts into perspective how serious the structural imbalance is.
And here's the simple reason that debt keeps growing. Every single year, the government spends significantly more money than it brings in through taxes. For 2025, that gap is projected to be around $2 trillion. And that shortfall, it just gets tacked right onto the national debt.
So where does all that money actually go? Well, the biggest ticket items are mandatory programs like Social Security and Medicare. That's followed by national defense. But look at that fourth slice there, interest on the debt. We now spend hundreds of billions of dollars every year just to service our existing debt. And that's a cost that just keeps growing as the debt itself gets bigger.
And this might be the most important chart of all. See, it's not just that the debt is large, it's that it's growing so much faster than our economy. The debt to GDP ratio shows how big our debt is compared to our entire economic output. And why does this matter? Well, a high ratio can lead to higher interest rates for everybody, it can crowd out private investment, and it really limits the government's ability to respond to the next crisis. Which leaves us with this one final, really provocative question. When you step back and look at the whole system, tax incentives designed to shrink revenue on one hand, and massive spending commitments that fuel the debt on the other, you just have to ask, is our financial system truly designed to find a balance anymore? Or is it now built for something else? For perpetual growth funded by ever-increasing debt? It's definitely something to think about.